Welcome into a daily editorial here on the KE Report. Going to talk a lot about gold and some of the nuances going on in the gold market with Jordan Roy-Byrne. He is the founder and editor of the Daily Gold. Jordan, you sent out one of your regular issues to subscribers, which I also receive, and there were a couple interesting comments that I want to share with everybody to give them a little feeling of what you write to subscribers, and also because I think these are very key points. First, starting out on the sentiment side, you pointed out that gold's net spec position declined to 24% of open interest, and its DSI, Daily Sentiment Index, remains at a 17-month low. If gold cannot mount a big rally here, you say back above 1308, then it would show a change in character compared to the three previous key lows over the past 17 months. Share with us what this means in terms of what a character change would mean for the market.
Okay, Corey. Well, first, let's look at how much gold rallied during those three sentiment lows and also three lows in the market. So we go back to December 2016, and I have the chart in front of me. And at that point, gold rallied from a low of 1124 all the way up to 1264 within 2 months. And then it got hit a little bit, but went up to 1297. But we'll just look at 1264. So that was a $140 rally. Then last summer, it made a low around 1204 in early July, rallied all the way up to 1362. So that was nearly $160. And then we go to December 2017 from 1238 to 1365. So that's about $127 an ounce. So looking at, you have $127, $158, and then $140. So these are sizable moves given the lows in sentiment. And gold, I believe it came close to touching 1250 today, but let's just say 12. Let's just call it 1250. The low is going to be 1250. A move, $120 move would take it up to 1375, and that 2016 resistance. So, and looking at the confluence of very strong resistance, that's around 1300. I mean, we could note the 200 day, which is at 1307. We could also note 1310. But even if gold were to rally from here to, let's say, 1310, I mean, that's only a $60 move. So that really pales in comparison to the moves we got at those other three oversold points. So gold bulls are really hoping that we're going to see a replay of what we saw at those other three lows. Okay, sentiment's pretty low, especially the DSI, not necessarily the COT. I mean, the COT is at a decent level, but last week we talked about how we'd like to see that come below 20%. But given where the DSI is, given how gold has cut below some moving average support, it lost 1265, I think, on a weekly basis. Given where sentiment is, we really need to see a strong move, or it's a change in character that shows the market is a lot weaker, because this extreme that we're nearing in sentiment is not going to be able to produce the same kind of rally that we had at those three other oversold points. Again, if it only rallies to 1310 from 1250, that's $60. I mean, that's basically half of what we had at those other 3 points, or at least the minimum rally from those 3 points. So that's my concern right now, is that, yes, in the very short term, we're setting up for a rebound, but there's so much strong resistance, Corey, around 1300 to 1310 that I don't think gold is going to be able to get through that level. And if that's the case and it kind of rolls over again from that spot, then we're seeing a change in character in the market, whereas where this extreme bearish sentiment is not producing the kind of rebound that we saw at other points when gold was rising but not breaking out. At least it was rising at those points. So that's my concern moving forward. And if I'm right about that, that would show a change in character in the market, that we're really not, we're definitely not in a bull market, but we're at a difficult point where the market is weaker and the path of least resistance is lower. So that's something to keep an eye out on for the rest of the summer.
Okay, so another quick comment here, though. How much worse do you think sentiment can get? You mentioned that we're close to some of these extreme levels. Can it stretch itself out, maybe continue to drift weaker and weaker on the sentiment side, and maybe get us through this summer without another huge fall, but set up maybe a more bullish bounce potentially?
Well, that's a good question because what happened at the December 2016 low is sentiment got really extreme and then the market sold off for, I think, more than another week. And so we could be seeing that now, where at the end of last week it looked like maybe we're getting a short term rally. Maybe we've seen the low, but the market's rolling over again. And the COT data comes in as of the end of Tuesday. So we're going to see, as of yesterday, we'll know on Friday, but of course, it's 3 days old. We will see the net speculative position, and maybe that's below 20%. I mean, maybe that gets down to 17 or 18%. That would be a lot more encouraging. I mean, the DSIs are, I mean, they're continuing to move lower. So it's definitely possible. Yes, to answer your question, it's definitely possible. I would think once we kind of get down to, I mean, if we move down below 1250, that would tell me that a bottom is probably imminent, because I don't think we're going to go below 1240 on this leg. So if we go below 1250, that would lead me to think we're a day or two away from the bottom. So in these types of situations, Corey, I'm more of the mind that I would focus a little bit more on the price targets than how oversold the market is, because that's just what I like to look for when a market is falling. A confluence of negative sentiment, but then a support target, a strong area of support where the market should bottom. So yes, I would look for, if gold is not bottoming today, then I would look for an absolute low below 1250. And if that happens, then we're probably a day or two away from rebounding.
Okay, one other thing that you pointed out in that issue to subscribers is that at each of these 3 points where sentiment has gotten extremely low, the US dollar has also turned lower. However, we look at the US dollar, and even today, US dollar is moving higher. It actually is quite a bullish chart, now back above 95 on the dollar index. If the US dollar doesn't turn lower, then this is another example that maybe that narrative is changing for the gold sector in terms of that big rally just not taking place. Talk about the dollar, though, and its strength today.
Yeah, that's a great point, Corey. First thing I'll mention, if you look at gold against foreign currencies, just very quickly, I wrote an article on this a couple weeks ago. It did make a 14-month high, 14-month high, but then it made a real vicious bearish reversal. So looking at that chart now, I think we've probably seen the top as far as gold against foreign currencies. What that means for precious metals and gold specifically is that gold is going to be more tied to movements in the dollar. And if we look at how strong the dollar has been during this correction since the end of May, up until a couple of days ago, I was thinking, okay, this is probably going to correct and consolidate for a little while. I wasn't thinking it would have a big correction. I was thinking it probably holds above 93, maybe 92.25, but just go back the last 2 days, and the correction now looks very bullish. Like there's a potential breakout here above 95 that would set up a very short-term measured upside target of 97. But this is very worrisome for gold, both in the big picture and in the short term. I mean, the dollar, if it punches through this 95 level, maybe gold will make it down below 1240 before it has a bottom. But I mean, you said it, Corey. This is different from those other 3 points, those other 3 sentiment lows. At those 3 points, the dollar turned lower and made a decent size move lower. I just don't see that happening at all. Looking at the dollar right now, I mean, I think the favorable scenario for gold in the short term would be the dollar doesn't break out. But even if it doesn't break out in the next couple of days, the dollar is still correcting in kind of more than correcting. It looks like it would be having a bullish consolidation rather than a sharp correction. And a bullish consolidation in the dollar, if that happens, then you would probably see gold mount a weak rally in the summer. Maybe it doesn't make it back to 1300. Maybe it only gets up to 1290 or 1285. So that's something to keep in mind. Wow, I mean, things have completely changed for the dollar in the last couple months, and and I wrote an article about this, but Corey, that 95 to 96 level is really important. And if we see the dollar punch through that resistance really easily, it doesn't have to happen right in the short term, but it could happen in a couple months. I mean, if that happens and the dollar punches through that resistance easily, then that's obviously going to put a lot of pressure on gold to the downside, especially given the fact that gold is not showing strength relative to foreign currencies now. That obviously is negative for gold and precious metals, but I don't think it would be the end of the world because a very strong dollar coupled with Fed hikes is eventually going to bring about much softer policy, which is what gold needs. I mean, we've been talking about how gold is probably not going to begin a bull market until the Fed is done hiking. Well, if the Fed they slow down their pace of hikes, and then you factor that in with a rising dollar, that's going to lead to the Fed stopping its hikes sooner rather than later. So it's kind of like, let's just take the pain. If we're gold investors, let's just take the pain here and now rather than have to, wait for it for, another year or so. So that's why I would prefer to see the dollar push higher, even though it would obviously be a negative development. The only positive to that is it would bring us closer to the Fed ending its hikes and starting a new cycle of cuts, and that would mean a new bull market in precious metals. But obviously, we're not close to that yet from here we are right now.
Yeah, it really goes back to that one scenario that you pointed out months ago, might even have been 6 or more months ago, where it could be beneficial for the precious metals to go through one washout, bring in more interest. I know it would be devastating to the gold bugs, but that can actually be a more longer-term positive factor rather than this grinding that we have where people aren't getting sucked in either on the high side or the low side because we're so range bound. Let's also talk again, kind of related to the Fed, but more so interest rates, short-term rates, long-term rates. The long end really seems stuck where it is right now, and the Fed really seems dedicated to keep on raising the short end. You would have to think that eventually the yield curve might invert, but that doesn't mean right away, again, that it's going to be good for gold or bad for the markets, does it?
Yeah, that's an excellent point, Corey, because there's usually a lag from the point at which the yield curve inverts to when we get a bear market or a recession. I don't have the exact charts in front of me or the data in front of me, but I mean, if you're listening, it's something you could look at and pull up some charts. Because when that happens, I guarantee you on all the gold websites, they're going to be talking about inverted yield curve. This is it, 2008 all over again. You have to buy gold right now. And yeah, that may eventually be the case. But as you said, when the yield curve inverts, I mean, there's points at which it inverted and the stock market kept running for another 6 to 12 months. The economy kept expanding for another 6 to 12 months. So that's just something to keep in mind. Yes, I mean, at this point, if the yield curve inverts, that will be bullish for precious metals eventually, but not necessarily immediately. And that's the key. And so looking at the bond market in long and short-term interest rates, I mean, in comparing those and what's really bullish for gold, it's two things, Corey. If interest rates are rising, we really want to see long-term rates rising much faster than short-term rates. That's been the problem for gold over the past 12 to 18 months. Long-term rates have kind of gone up a little bit, but short-term rates have been rising. They've been screaming higher, rising much faster than long-term rates. Okay, now that we could be moving into the other scenario where long-term rates aren't going to break out, they're going to stay stable. Maybe short-term rates will keep rising a little bit till the inversion. In that scenario, with long-term rates not really rising and they're staying stable, for gold, we really want to see short-term rates going lower. And of course, that means the Fed cutting. So obviously the Fed, first they have to slow down their pace of hikes, then they have to finish, then they have to pause and move to a cut. So it's eventually when they stop hiking and move to a pause, I think that's going to be the point when you really want to buy precious metals. But we're not quite there yet. I mean, they're not going to go from, we're going to hike 2 more times this year to suddenly cutting. I mean, that's what some gold bugs have to realize. It's a process. I mean, you talked about this last week, Corey. There's There's dominoes that have to fall before they get to that point. And yeah, we could be seeing the very first domino, which would be a yield curve inversion. And then at that point, the Fed would take notice. They probably slow down the pace of their hikes. But that's the first in a series of dominoes that need to fall before we get a precious metals bull market. So interesting developments here in the bond market. But again, it's not quite, it's not yet bullish for precious metals, but at least we're very close to seeing a first domino fall, so to speak.
That's a good point there, Jordan. And it seems like, again, we might just need to wait a little bit longer, but let's look at what goes on internationally, but let's also look at what goes on with gold's upcoming bounce. We are going to get a bounce here, but a bounce just above 1,300 really isn't good enough, as you've pointed out, from where we are in the sentiment whole side of things and some other bounces over the past about year and a half. Right now, though, we're still hostage to the Fed, hostage to the general markets, which continue to hang up there pretty well, and that's what's going to keep gold, I think, fairly constricted in terms of upside movement. But, hey, Jordan, great chatting with you. As always, great to get your newsletter. I always appreciate reading over it, and hopefully we do get that bounce in gold, but let's see how high it goes. Jordan, have a great rest of your day. Thank you, bud.